Welcome, 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 everybody. Welcome to Crashes and Taxes. I am your host for this podcast, Rebecca Walser, and I'm so glad you are joining me today. And my team is going to make sure, my producer is telling me, make sure that you thank the people that are going out and giving us a five-star rating. You know, I don't even know how these things work, but I guess you can go to Apple, Tunes and Spotify, and you can say, oh, I love this podcast. Give me a 5-star rating. I watch it listen to it all the time, watch it all the time. It is video as well if you want to watch the video version. And thank you for doing that, because this podcast is growing by leaps and bounds, and we love that, and we're just excited to have that happen. So thank you for that. I want to get right to the topic, and that is bonds, yields, interest rates, the Federal Reserve, the equity market. What is going on these last couple of weeks? So this past week and the week before, we're starting to just see a lot of volatility in the equity markets. And yet this is not an equity issue. This is not a stock issue. So what are you saying, Rebecca? Why are we having an equity volatility? I mean, just to give you a perspective, and I was looking at the results of 4 days. And in 4 days, 3 of the 4 days, the major indexes had gone up, changed over 2% in 3 of 4 trading days. That tells you that there are some issues. Now, at the end of earnings season here, just to give you a perspective of how equities are doing this year, and I'm really talking now about the organic core of the companies in America. We had 80% of our companies beat on this most recent earnings season. And yes, it's not really that good, because we did have everybody reset expectations with the virus. So people reset expectations lower, as they had to. I mean, obviously they're not going to hit the same numbers with the economy completely stopped last March. So they reassess their numbers, they re-give us projections, and then 80% of those projections were actually beat in this last earnings season. So we've got equities that are doing good. It's not really an equity issue. We actually have had some great numbers on retail, on housing starts, on construction contract costs, on, we've had a lot of positive news, lower job loss numbers, really some good positive news on the economic equity side for companies. So what has been the problem? Well, last year, the Federal Reserve saved America's hide, because had we not had the Federal Reserve help the congressional action of CARES and HEROES Act, and now the new act, if we had not, under this administration, if we had not had the Federal Reserve step up to help, we would not have gotten the stimulus that we needed. So to put this in perspective, right now, the Federal Reserve for 2021 has committed to buying $80 billion of Fed treasuries a month, and $40 billion of MBS, or what we call mortgage-backed securities. So they're basically stimulating at a clip of $120 billion a month, or $1.3 trillion per year. And you might say, wow, is that normal? No, it's not. It's not normal. It is still as a result of coronavirus. So you've got Chairman Powell, Jerome Powell, who's sitting in that position, and who's got a really difficult, unenviable task of trying to figure out how to not allow this economy to crash while we still remain somewhat shut down, yet not stimulate too much, too fast, because we are starting to reopen. We are starting to get some states reopen. We are starting to get some economic life organically back in this country. And as that comes online, if you will, we need less federal stimulus, because if we have both happening at the same time to too hot of a degree, you will get inflationary pressure. And this is exactly what happened. We had the steepest yield curve approximately 2 weeks ago, when for the first time in I don't even know how long, our 10-year Treasury note hit 1.6%. So then you started to see the tech industry really start to come down and have a sell-off. Why would people, just ask yourself this question, why would people sell tech because interest rates are higher, or the 10-year note is 1.6%? Why? I forgot I'm doing a live podcast and there's no one going to answer this question. I'm just kidding. I'm talking to myself. I can do this. The answer is people know that they had a substantial run up in equity prices because of last year, because we overstimulated last year and a lot of the money made its way into the equity market. So stock prices are at really high highs. As you know, we've hit highs even in this last month. So equities are high. And people all of a sudden see, oh, I can buy something that's 10-year safe, guaranteed at 1.6. Why won't I do that? So people are taking some profits off the table that they've earned over the last 12 to 18 months, and they're buying up some more safe, as we call it, some safe positions where they're getting a 1.6 yield for no risk. And so what happens as bond prices rise, people leave equities and put some money in safety as they take off some of their they pull some gains. Now, the other thing that happens is the value of your portfolio. If you've got a monthly statement and you might see that your bond prices are going down in value. And there's this terrible common misnomer out there that bonds are safe. And I want you to understand that that is not necessarily the case. The safety of a bond comes from holding the bond to maturity. When I buy a bond, I have specific contractual terms of that bond that if I hold that bond through maturity, those contract terms will be delivered. But if I sell the bond at any time at its current market price, I'm going to have to deal with whatever the current interest rate environment is. And that's where we get into the inverse relationship between the value of a bond and the interest rate. So let me just give you a really clear example. Let's say I buy a $100 bond whose current interest rate is 2%. And next year, the Federal Reserve stimulating too fast, the economy reopening too fast, creates price inflation. So now the yields have gone from 2 to 3%. Let's just say we're using easy numbers here. So now we have a 3% $100 bond. Well, who's going to come and want to buy my $100 bond at 2% when the current market $100 bond is giving them 3%? Nobody. Nobody's going to buy a $100 bond for 2% when they can go out to the Fed and buy a $100 bond for 3%. They're not going to do it. So what happens to my bond that I bought last year when it was at 2% is its value goes down. And it's a mathematical equation. Its value goes down an exact amount to make my 2% yield become a 3% yield. So you can do the equation. You can solve for what the value of your bond is by just saying, what amount does my bond have to get priced at in order to make my yield go from 2% to 3% to equal the market yield? So this is what happens as interest rates rise. The value of current existing bonds must go down because they must make up for the fact that current market rates are higher. So there's an inverse relationship. As interest rates rise, existing bond prices go down, and it's the exact opposite. If interest rates are high and now they're starting to drop, well, that means I'm holding an existing bond that has a higher return than what the market is delivering. So now my bond is going to appreciate in value because it's more valuable because it's paying an interest rate that I cannot get in the market. So bonds are very interest rate sensitive. In fact, they are defined, their value is defined by current interest rates every single day. So if you get your statement and you actually own a specific, let's say corporate bond, for example, and you see that the value of your corporate bond has gone down, even though you haven't sold it and you don't understand why is my corporate bond gone down in value, because interest rates have gone up. So the bond yields have gone, or the bond prices and valuations have gone down. And so what's happening is these are all economic factors tied together. But what is happening is the Federal Reserve has the difficult job of trying to stimulate the economy enough to not allow us to go into any kind of recession while we're still in the middle of the throes of coronavirus and working our way out of that to get reopened fully. And yet, as we're reopening, they're continuing their same stimulus level, which has led to inflationary pressures on interest rates. Rates have been the highest they've been in, I think, 2 years at least. And that's created inflationary pressure. People have taken some gains off the table of their equities and gone into safety, and that's why you're seeing some volatility on the equity front. And people are wanting to know, how long is this volatility going to last? And the truth is the Federal Reserve has the really difficult position right now that I wouldn't want, which is to figure out what is the sweet spot, the right balance of stimulation without over stimulating and getting to inflation. And that's a really tough nut to crack because we've not been in a 100-year pandemic in modern times. And certainly in modern times where we're leveraging the use of the Federal Reserve to help us with employment and inflation. Remember, there are two main jobs: are to keep unemployment at a certain level and to keep inflation at 2% as the target. So that's their main job. They're getting into a lot of other things. And right now, I think Powell's having a hard time. But we are going to have the next Federal Open Market Committee meeting on March the 16th and 17th. So that will give us some really great additional perspective into how we're going to get through this time. But I want to tell you, since we're talking about bonds, I think one of the biggest financial innovations of the last 20 years is an alternative asset class that can really be a bond replacement that I've really, truly enjoyed as a bond replacement. And so bonds, the reason people buy bonds again is because they can have some level of security of that contractual term that if they hold to maturity, they will actually realize. And so there's that guarantee there on the bond, which it makes it attractive to deal with volatility. So you don't have all of your investments in equities. We obviously also have some bonds. And of course, we are a big user of bonds. That's definitely true. But we also use an alternative to bonds that we like to leverage outside of our market-based portfolio. And this is, again, where I say all of the innovation has really come from for the last 20 years. And how these accounts work is basically we invest money, but our money is we're given a contractual guarantee of 100% protection, no risk of loss, but all of the growth is derived through options, call options. So basically the financial institution is buying call options on that account. And as those call options, so market-based options, if you don't know what a call option is basically I'm buying the right to basically get the growth. So I take an option, I pay for an option, and the option gives me a right to basically buy the growth of the market. It's the easiest way for me to explain it. And so basically, I get a call option on future growth. If the market performs, the option gets exercised and growth comes into my portfolio. But if the market does not perform because the market is losing, then there's no growth to call on. And so the option will expire unused, but I fully protected that money that entire time. I exposed it to no risk of loss. So it's really a guaranteed way to have complete safety, yet still get market-based growth. And this has been a really great bond alternative, I'd say, for the last 10 years. And to give you kind of a perspective, in a 10-year good run, we averaged about 8% in the last 10 years on that kind of alternative, and that's a guaranteed account, not a guaranteed return, but a guaranteed account from principal loss. And then doing a down market, like a 10-year down, like the lost decade. We call the lost decade the period of time of 10 years where we had the first time ever in the history of America, the first and only time where the S&P 500 actually went down -1%. And so that was really from 2000 through 2010, where we did lose 1% on the S&P. That's never happened before. It hasn't happened since. During that same time frame, this alternative asset class did about a 4.5% return because 4 of those 10 years were negative. We didn't participate in any of those negative years, but 6 of those 10 years were positive, and we participated in all of those years to such an extent that the average return for 10 years was 4.5%. So this is where it comes to become a bond alternative. You have an asset class that's guaranteed against zero loss, yet even in the worst 10-year period in the history of America, it still did a 4.5% 10-year annualized return. So you can see why I love this account and how it can really be leveraged in a really positive way and an income plan and in a strategy. So This is a podcast. This is not you guys. I'm not talking to you guys as clients. So if you don't have something like this within your portfolio and your financial professional isn't leveraging the safety bucket to give you further probability of success. Remember, if everything's in the market and the market crashes, then what are we going to live off of the next couple of years? We don't want to spend money on a down portfolio. We need to let that portfolio breathe. What that means is we need to let that portfolio recover. What that means is we don't need to sell anything from that portfolio to live off of. We need to let that portfolio recover and breathe. So we have to have an alternative asset class to turn to live off of when we're letting our portfolio recover. And that's where this asset class can really come in. And it really does increase your mathematical probability of success. Normally, I can't speak to your specific portfolio, your specific situation. This is not generalized financial advice. This is just a podcast, just giving you financial ideas of how to increase wealth and reduce volatility while you live your best life financially. So until next time, everybody, thank you for joining Crashes and Taxes. You can always reach out to my company, Wallster Wealth Management. You can always reach out to us. But otherwise, love being with you guys every week. Have a great one.